Well, good morning, all. This is Alfred Einstein with the Specialized Pockets of Knowledge Studios, bringing you my introduction to mortgage note investment this morning. So prior to clicking on the video anyways, you decided you wanted to learn something about investing in mortgage notes. And that's what this is going to do. It's going to be the introduction and just give you a real ballpark look, a 30,000 foot look, if you like, to mortgage note investing. So the first thing you're going to have to consider is whether or not you want to buy mortgages that are either current or in default, because they're distinctly different and they're different animals. They're zebras and giraffes. So a mortgage that's current is just like that. They're making their payments on time. The borrower is making their payments and everything is happy. The borrower is happy, the bank is happy, everything is good. But sometimes the mortgages are held by individuals and they want to sell it and they want to get some money back. So they'll sell their current mortgage. On the other hand, there's mortgages that are not paying and they're in default. This is going to be the majority of the loans you're going to bump into, especially if you follow my training. These are borrowers that are not paying for a specific period of time, 6 months, 9 months, 2 years, it doesn't matter. And there's categories of default as well. So there can also be non-monetary defaults. They can not be making their tax payment like they're supposed to, or their insurance payment. That's also a default. In any event, this is what you're going to see: two different categories with different versions of each. So they're either paying or they're not paying. It's like you're either pregnant or you're not. You know what I mean? Okay, mortgagee and mortgagor. EE, as you learned in real estate school, always receives. But in this case, the mortgagee receives security. So the mortgagee is the person that loaned the money. So when you buy a mortgage, you're going to be the mortgagee, and the mortgagor is the borrower. So these are two terms that you need to get familiar with if you're not already there. Okay, current mortgages. Here we go. Who invests in current mortgages? The investors that invest in current mortgages are most likely just looking for an increased return. They're looking for a safe investment and an increased return, just like those in Florida that acquire tax certificates. Very safe investment. They're up in their yield. They might earn 6, 7, 8, 9, 10% on their money versus 2 or 3, what's being offered in the simple money market, stuff like that. But those that invest in current mortgages have money already. They're not looking to make money. They're just looking to increase the yield that their money is providing them. So what's the availability of current mortgage notes? I'm going to suggest that they're out there. And the least more that you see, or the number gets reduced, the higher you're going to have to pay. So you're going to go ahead and figure out how much you want to pay and what your returns is going to be. For example, when you buy or you price a current mortgage, they're going to start out at par. So par is 100% of the principal that's owed. So if there's par, if the principal is 100,000, then par is 100,000. If it's 90,000, then it's 90,000. But when you buy, and I'm going to go to pricing, when you buy a current mortgage note, you're going to pay close to par, because let's face it, why is the guy selling? He just wants a little bit of money, or maybe he wants to send his kids to school, whatever the reason. But they're not going to give you a huge discount. They're not going to give you 50 cents off or 70% off. You're going to pay between 90 and 98%, and just start receiving that mortgage payment as income. And if you buy a mortgage that's $100,000 and you end up paying 98, when they pay off, you get the extra 2,000 as a kicker. Good for you. That's your return. So guys that buy current mortgages are people that are just looking to increase their yield, and they don't want to have to work too hard. Because if they wanted to work hard, they would buy delinquent mortgages. Who invests in delinquent mortgages? Me. I do, and probably you too. You invest in delinquent mortgages because you want to make money. You want to find a deal that you're not going to increase your yield by 2%, but you want to make 25 grand. So that's who invests in defaulted mortgages. What is the availability of defaulted mortgages? The availability is high, But just to give you an idea of how the mortgages get down to the little guys like us, is they're sold in huge bulks to big companies, big hedge funds. They buy them, they filter out what they want, and then it goes to the next level of buyers. And then they buy them, and they spend a lot of money, and then it goes down to the next level of buyers until it trickles down to the buyers like you and me. What that means is there's usually a problem with those mortgages, and some of the mortgages, there's 5 or 6 problems that all the previous guys that looked at these loans didn't want to deal with. So what you're going to have to do is you're going to have to learn how to bring value and a solution to these problem mortgages. And you do that by first creating your business models. And that's a plural because there's several items that go into those models. We'll talk about that another day. So what's the pricing for defaulted mortgages? The pricing for defaulted mortgages is good. This is where you're going to make your money. You're going to buy something for 20 cents and then you're going to sell it for 60 cents. You're going to make 40 points in a matter of months, less than a year for sure. So the point is that pricing is good and you have to bring a skill. You have to bring some value to this thing to increase the price when you sell it again. And there's many ways to get out of it. And we'll talk about those another day, but pricing is very good. So you can make some money by buying for 15 cents and selling for 65 cents. So what does a typical loan offering look like? There's 3 types of offerings that are going to come down the pike. We're going to have a negotiated bid, a sealed bid, and an open bid. I'm going to get into exactly what these look like. A negotiated bid. So let's see. A negotiated bid is when the seller of the mortgage pool gives you a price for the pool. In other words, they say, okay, this is what it's going to cost you. And you decide after your due diligence whether or not you want to buy this pool. Now, what we did with my very first one, and we're going to get into that in a few minutes, we put loan level pricing on the pool. In other words, we're buying the whole pool, but we have to put individual prices on each loan so cumulatively we could come up with a price that we wanted to pay for this negotiated bid. But however, the negotiated bid came with a price. They said, okay, we told them we want to buy something for 26 cents a loan or 26 cents on a dollar. And they mean the broker, they put the package together and they sent it to us. They said, okay, you pay 26 cents on a dollar for these loans and it's yours. But we had to do loan level bidding, low level pricing so we could calculate whether or not it was worth 26 cents. Now, the most important feature I want to bring up with regard to negotiated bids is these pools that are negotiated and they're sent to you, they're professionally merchandised. And you can read the definition, strategically offered for sale with the pool designed to include a mixture of loans that are very desirable, while some not so desirable. What that means is out of those 26 loans that we first got, we got 7 loans in that pool that we couldn't live without. They were great. We were going to make money. The problems were skinny or small, and we were happy with it. But the balance of the pool, some of it was average, but the bottom 7 loans in that pool were horrible. I remember when I was up in Ohio looking at one of the properties, it had all the copper stole out of it. All the copper was removed so they could sell it. I don't know what they want with it. Of course, I know what they want with it. So do you. But they stole all my copper, and now I have a house I can't sell it like that. And our model was designed to deal with homeowners that were still in the property. So now we have 7 that are perfect for our model, 2 or 3 that's here or there, but the balance we had to foreclose, and that's not what our model was. So it was a problem. Anyways, sealed bids. This is the sealed bid comes down. You're going to be bidding against other investors. If you ever bid on HUD foreclosures, this is what it's like. Everybody gets information. You have to put together your bid and you have to send it in, and the top 3 get chosen to continue. And anyways, sealed bid is it's very close to the way we're doing business now. We're doing business now with open bids. So what happens with open bids is you receive a pool of 26 loans, 25, it doesn't matter, a varying amount. And the seller of the mortgages in that pool will allow the investors to bid loan level. In other words, you'll bid individually versus having to bid on the whole pool. With open bids, the seller generally does not offer a strike price. In other words, a price that they're willing to accept, but they will allow you to come up with a bid for each and every loan. So if you want to bid on 3, you bid on 3. You want to bid on 2, whatever. You get the idea. So that's what happens in the current market right now. And you can even bid online. You can bid online. You'll be bidding against other investors. But you'll get a feel for this. But the most important things are just coming up here. Rockland Trust, that's the company that we established to buy mortgage notes. And I partnered with a company called Eurotrade, coming up here, I think in a second I talk about it. Let me see here. I'm getting rid of my notes. Sorry, I'm old, so I don't remember everything like I'm supposed to. Okay, so Rockland Trust. Let me see what I wrote here for this. Most investors can only dream of purchasing defaulted mortgages. In 1995, I opened Rockland Trust Corp. to purchase defaulted mortgage notes. I crawled along for a few years just trying to establish my tiny business because it was hard back then because I didn't have anybody to teach me how to get into the business. So I got my first big break in 1999 when I was asked to participate in the purchase of a large defaulted mortgage note pool that my personal financial advisor was buying. So my personal financial advisor, I can't remember his name, he was buying a pool with some partners. And he knew that I was an expert at foreclosure, and he thought that might come into play eventually, but it certainly would come in use. So he invited me, and the other partners in the group figured that my mortgage and real estate knowledge would prove invaluable to the success of the pool. I figured it would be an easy gig, and boy, was I wrong. I couldn't have been more wrong. So Weston 1, that was the pool that we bought. We went to a broker. His name was Gene there. And he's the guy that gave us the negotiated pool for 26 cents. And my partners, their name was Eurotrade. So here's the story of my Eurotrade experience. Over the next year, we toiled away for what seemed at times for nothing. And I mean nothing. Zip, not a penny. We didn't realize any money until late 2000. We just happened to do everything wrong. We fought when we should have settled. We let our note seller front load the pool with vacant properties, and we paid too much. When we finally sold off the balance of the pool in early 2001, I was grateful to get my money back, to get our original investment back. And I know some of you investors know how good that feels. It looks like it's going to be terrible, but it ends up that we got our money back. Thank goodness. I would have hated to explain that to my wife. The defaulted mortgage note game is a real estate contest of strategy, personal contact, and skillful negotiations. If you're terrible at one of these, bring in a partner that's excellent at it. When I say strategy, the model for collecting your mortgage notes are going to have to be laid out, and it's going to have to make sense. Personal contact. My loan model, I'm in contact with all my borrowers to start. I want to get that note reperforming. As well as that, you have to be a skillful negotiator. Read books on negotiations. I'll put a list of books on the bottom that I read. Very good stuff. Now, you're not going to be able to take everything because one of the books is written by an FBI hostage negotiator. But it's a good book. And it will teach you. You'll pick up little things here and there, which is what I hope you do from this video. So after the dust settled in 2002, I made a hobby of reverse engineering each and every one of those loans that we bought because I wanted to figure out what we did wrong. Why were our hopes so high? And why did we essentially, you got our money back, why did we fail so miserably? Over the next several months, I was able to piece together hypotheses. And slowly but surely, I began to understand what our monumental failure came to be. While we followed the book on our way out of the pool, we simply failed to understand what we needed. We needed a clearer way to find our way into the pool, on the way in. It simply isn't enough to buy low and sell high. We really didn't recognize how to address each individual situation because we did a very poor job at studying the pool prior to buying it. Simply stated, we did no proper pre-bid due diligence. Now, pre-bid is the wrong word there. We didn't do our post-bid due diligence real well because pre-bid is skinny. You just look for the value, confirm information, stick your bid in, and then everything starts after you get awarded the post-bid due diligence. Most of the experience of the group stemmed from real estate. Some were brokers, others were wholesalers, investors, and I was a foreclosure maven. Making money with defaulted mortgage notes is a different process from making money with simple real estate investment. You have to have a lot more skill in here. I know it sounds funny, but a foreclosure investor, all they do is go to the sale, bid, they get the property back. You either get clear title, you have to handle an objection now and then. You might have to deal with someone that was missed in the foreclosure process, but it's a lot simpler, and there's less moving parts than in this business of defaulted mortgage notes. Will that foreclosure experience bring you some value? Oh, heck yes. It'll make you dynamite in this business. Pardon me. So in conclusion, over the next several years, I've been fortunate enough to be asked by many of prospective note buyers to help them establish due diligence protocols for their individual note buying businesses. That's what I'm going to do for you. I'm going to help you establish your protocols. I'm not sharing any of their company secrets or proprietary information with my videos. Just my ideas and standards I learned from many years of reverse engineering, literally tens of thousands of foreclosures and defaulted mortgage note transactions. So what that says is I have a lot of experience in this. I'm happy to share it. I'll put my contact information into the description of the video. And if you want my help trying to get some of this information into your business, I'll be happy to help you with it. But in the meantime, I think it's time that we're finished. It's a little bit longer than I like. I talked a little too fast. I apologize. But if you watch it again, and I'm sure you'll be able to pick up a nugget or two, especially if you're just getting into the business. And I'm happy to help. Like I said, if you want to implement some of the stuff I brought forward, you can contact me. In the meantime, this is Alfred Einstein. I hope you have a great day, and I will see you the next time we get together. Oh, by the way, would you subscribe for me? I'd appreciate it. And I don't know why, but I would appreciate it. Thank you. Bye-bye.